Perfect. All right. Good evening, everyone, and welcome to We Rise In Presents Financial Wellbeing Webinar with myself, Faith Locken, as host, and our guest speaker, Jerran Whyte, who I'll introduce in a few minutes. So tonight's schedule, we'll do a brief introduction, so probably be about 3 to 5 minutes introducing We Rise In to those who don't know about We Rise In, introduce myself, and also our speaker, who's Jerran Whyte, and he'll be running a quick sort of presentation looking at the state of the market and sort of looking at generational wealth creation, and all that good stuff, really. And then we'll move into the Q&A portion of the session. I attend a lot of these kind of webinars, and I always find that it's always better to kind of make it more conversational. So as we go through the slides and the presentation, if you have questions, pop them in the chat box. We might answer them during the presentation, or we might wait till the Q&A session to answer them. But it's going to be very informal. Just a bit of disclaimer, obviously this is a financial wellbeing conversation. This isn't, please don't construe this as advice. You're sort of advised to seek your own do your own research and seek your own advice from your sort of financial planners or wealth managers. So this is just a general session where you can kind of come and ask your questions, but just, understand that, we're not kind of giving advice in this session. It's just more of a general, I don't know how to say it, but general just understanding around investments and wealth management. So in terms of introductions, so about We Rise In. So We Rise In is a business initiative. Our mission is to inspire, elevate and develop the careers of Black professionals across corporate industries. We were founded back in last year, so 2021, and since then we've been helping Black professionals in the mid to senior level in their careers through our mentorship program and our leadership programs. And we also work with corporate entities as well to help them improve their diversity, inclusion and equity agendas within their organizations. In terms of what we offer as a network, so we are a network of mid to senior Black professionals. We offer events both in person and online, such as this one that you're attending today. We have various kind of seminars and offer professional development programs like our mentorship program and our leadership program. And we also offer corporate memberships. Quick introduction to myself. This is always the awkward moment. A lot of you might already know me or met me at certain events hosted by We Rise In. So my name is Faith Locken. I am the founder of We Rise In. I'm also a chartered surveyor and real estate professional by background. I've done a lot in the sort of diversity, equity and inclusion space, and most recently obviously setting up We Rise In to target and support Black professionals off the back of the death of George Floyd back in 2020. This was kind of my answer to support that mid-level range, because we were seeing a lot of a lack of retention, as it were, in corporate industries at that level. So why are you here today? Obviously it's a financial wellbeing webinar, but I'd be interested to hear from you guys. So just pop in the chat box why are you here today? Are you here to just support We Rise In and support the mission? Are you here because you've got a specific question that you want answered, or are you interested in investment? I'd like to kind of hear what you guys are trying to get out of this session today, just so that it can help me kind of inform the questions that I'm going to ask Jerran, and also helps Jerran think about what he's going to kind of present in a few minutes. So I'll give you about 10 seconds or so to just pop into the chat box what you're looking to get out of today. Feel free, don't be shy, as Holly said. Feel free to post either to everyone in the group or directly to one of the co-hosts, so myself, Holly, or Jerran. interested in hearing more about finances before going further in my career, excited to hear what will be discussed today. Yeah, that I'm in the, I think I'd say I'm in that kind of camp as well, in terms of, I think a lot of people on this call are either at that kind of middle level or senior levels in their career, and are really looking at how they can use their income and make it stretch further, particularly in the times that we're living in at the moment. Nisi's here to learn and absorb. It's my first webinar with you folks, so no expectations. Thank you for joining us, and welcome, and hopefully you'll join many more. Supporting We Rise In, finally had free time this evening, so wanted to attend. Yep, super busy. I know everyone is, so yeah, it's good to hear some of the reasons why you're coming today. So just moving on. So wealth creation, financial freedom, legacy planning, generational wealth, investment, market update, maybe some of the reasons why you are joining the call today. We will aim to cover as many of these points as possible. If we don't cover them in the presentation, feel free to ask questions in the Q&A, and then failing that, feel free to contact Jerran directly and get some time in with Jerran to answer any questions that we miss off. So, moving on to the man of the hour, the person that we're all here to see. So Jerran, who is he? So Jerran Whyte is the managing partner at Belvedere Wealth Management. He's a senior wealth and investment manager, so he's FCA regulated. He has 13 plus years experience working in various different countries, including Germany, Spain, and the UK. He has clients all over the world, in the UK, in the EU, in the US, and in Africa. His clients range from basic rate taxpayers all the way up to ultra high net worths, so UHNW. You may see that acronym later on in the presentation, so that's what that stands for. It's ultra high net worth. So Jerran basically covers and supports clients at all levels, whether you're earning basic or whether you're sort of earning the millions, the billions, Jerran? I don't know. Let us. I'd be interested in that, actually. I might ask that question, like, what is it? What makes an ultra high net worth? And he specializes in helping clients create wealth and achieve financial freedom and get their, sorry, give me 2 seconds. Achieve financial freedom and legacy planning and the like. So I will now hand over to yourself, Jerran, to talk about what you're going to cover and to launch into what you're going to be talking about.
Perfect. Well, thank you very much for Faith for having me. We Rise In. Thank you very much for having me this evening to talk about something that I'm sort of very passionate about and can talk for ages about or around. Because of the sort of format, for me, I'm a very we could talk. I could talk at people, but I'd rather talk to people. So for me, I love the conversational element of these sort of seminars. So I'm going to try and keep the seminar, the presentation part, as short as possible. And and what I wanted to talk about was really just understanding the world we're living in today, because the reality is that what we've experienced, or what a lot of people have experienced over the last decade, and coming into that sort of market, is in essence not what we're going to be experiencing for the foreseeable future. So I think it's super important that when we talk about building and creating wealth, we understand the world we're living in today and understand the market and the market conditions that we are in today. So the things that I'm going to be talking about is the market, and then really just touching on sort of some redefining wealth and what that means to me, and what that means, and what I sort of talk about with my clients. And then I'm going to go on to talk about some of the things, some 6 key principles that I think everybody should be utilizing and taking away and implementing into their daily lives. And then we'll go into my favorite part of the Q&A part of the conversation. So first and foremost, the market. It's as I said, sort of we for the last 10 years we've experienced, or we've seen a sort of a market that has effectively just done one thing, which has just gone up. Now, for those that have been in the markets or kind of know how market cycles work, we understand and we know that actually we're due a recession, we're due a crash. Typically speaking, the market drops or crashes every 10 years, there or thereabouts. Now, why is that not a bad thing? It's a good thing because it allows the market to reset, but also what it also allows the market for, fantastic buying opportunities as well. But this is quite a sort of a bit of a, I want to say worrying time, but definitely sort of a different situation. A lot of people here will never have seen this sort of market condition. And to be fair, they say that this market condition you probably won't ever see again, or probably might not ever see again, because there's so many different factors coming into play. And I've named a few here just for us to talk about. So what the biggest, sort of the elephant in the room, you could say, is inflation. Inflation actually soaring through the roof. And that is affecting everything from our day-to-day shopping, from sort of the money in the bank, from sort of fuel prices. And it's important to understand why that is the case, or understand the fundamentals behind why inflation is soaring so high. So as in 2020, we had the COVID crash. And this was the part where everybody felt, okay, that's it. That's where the market's going to crash. That's the time where we're going to go into recession. But what we saw was the banks, and rightly so at that time, Chancellor Sunak doing whatever he's known as the Chancellor that does whatever he needs to do, or doing whatever he takes to support the people. And what they did was effectively just continue to print money, and continue to print a lot of money. And what we found was that when we should have gone into a recession, because there was so much money in the system, because there was so much liquid, and because effectively people were sort of, because of the furlough not working, they had money to play with, the market was propped up with all this, you could say, fake money in a way, or sort of false economy. In the COVID period, the COVID time, what we experienced was a very much a disruption to the supply chain, the global supply chain. And it's sort of very interesting. And I didn't realize how connected the world was until the Donald Trump sort of situation saga, where, so he's making a tweet from the other side of the world, which has a knock-on effect in China, which has a knock-on effect in Europe, which has a knock-on effect in Russia, for example. So it was really from there that I really started to realize how connected the world is. And we saw this again play out very much so with the COVID scenario, because when COVID did happen, we saw a massive slowdown of the supply chain. Effectively, the factory of the world, i.e. China, near enough grind to a halt because they're employing this zero COVID policy. Now, what we did see was, I call it a flash crash, because what we saw was that the market crashed, and then literally within weeks, it rebounded as if nothing happened and soared to new heights that we're sort of dropping from now. But what we should have seen is a massive slowdown. But again, because of the printing of money, because the false economy, we didn't experience that. We're experiencing it now, though. That's the problem. We're now experiencing that slowdown that we should have been feeling in 2020. We're now feeling that now. So because of the slowdown in supply chain, what we're starting to see is inflation starting to rise, the simple supply and demand element. Yeah. So the supply is not there, demand is shooting through the roof. This is now causing prices to increase, inflation rise as well. And typically the only way, or one of the key ways that the banks can employ to reduce inflation is to increase interest rates. The problem is that you increase interest rates too fast, you cool the economy too quickly. You cool the economy too quickly, we end up in a recession. So the banks are in this sort of very precarious situation where they're trying to slow down inflation soaring so fast, and but without sort of effectively pushing the economy into a recession. As you can see, it's sort of I wouldn't say they're failing because it's some past, but it's a very sort of precarious scenario, precarious knife edge situation that they're in. And then we go into the war in Ukraine, we go into the war in Ukraine and Russia. That, in essence, in itself, is also causing, because of the, it is also adding to the pain of the supply chain, because we've got now Russia sort of blocking off the Black Sea and blocking off sort of cargo coming in and out of Europe. Then we've got the problem of Ukraine going into war with Russia, of course, and with that, wheat and food prices starting to soar because of that. It's surprising how much wheat Ukraine supplies to the world. It's surprising how as Europe, we're so reliant on oil and gas coming from Russia. And all of these factors are, again, playing into the inflation problem, which is the key issue that we're seeing today. And then we can go to the other side of the world, which is China, and China, again, employing that zero COVID policy, where if they have one case of COVID, they shut down a whole city. Millions and millions and millions of people just go into lockdown. The problem is, again, is that with China, China is our factory. It is our manufacturing arm of the world. So if they go into zero COVID lockdown, that again just has a knock-on effect on the supply chain, has a knock-on effect on inflation, i.e. increasing inflation, which then means that the banks need to increase interest rates even faster to cool inflation. And as you can see, the cycle that sort of cycle that we're in is really just starting to play out even more so. And that's the problem that we're seeing. I mean, some people say, and you know, some of the older sort of bankers that I've spoken to about this, they're saying that are we seeing that sort of double-digit inflation that we used to see back in the 1980s? Obviously, I just been born then, so I hadn't really felt it, but I heard that it was you know, terrible times in sense of double-digit 14, 15, 16% inflation. Right now, where we as the UK are around about 8.1, 8.2%. And for me, these things are so important to understand what's going on, because from there, we can really start to understand how we should be employing our money and saving our money, investing our money going forward long term. So the things that I want to sort of just very touch on very quickly is just sort of going back to basics in a sense of redefining what wealth is before we come on to some of the key issues that I think that we should be looking at or focusing on. So for me, redefining wealth, sort of first and foremost, dispelling some myths. I genuinely do believe that there is a difference between rich and wealthy, and rich. Robert Kiyosaki points out very beautifully. He says, rich is about having money, wealth is about having time. I think we need to really redefine what wealth is to ourselves and really understand, what are you trying to do? What are you trying to achieve? What is your focus? For me, when I'm investing for my clients, I always keep banging on. What are we trying to do? What's the long-term goal? What's the long-term aspiration? What are we doing now to help ourselves in 10, 15, 20 years time? A beautiful, another comment is that investing should be like watching paint dry or watching the grass grow. If you want excitement, go to a casino. Yeah. The three key ingredients into creating real wealth. First, ability to make money. Literally, you can't make money if you don't have money, full stop, right? And that's why it's so important to make sure that we go on to managing our money properly, which we'll come on to a little bit later. The second, time. Forgetting timing, but rather time in the market. So forget trying to time your entry, but rather time in the market. And then third, compound interest, the eighth wonder of the world. It's not necessarily how much you get paid, but rather what you do with it that determines how quickly you build wealth, generational wealth, legacy wealth. What I want to do is really just go on to now the 6 key principles. So if you can just go on one more slide, Faith, please, if possible. And the 6 key principles of wealth creation. So the first thing that I always get asked, what do the wealthy do well? And the first thing they do is they make sure that their money is working for them. They make sure the money's working for them. And that sounds very simple. But as Einstein put it, if you can go down one more slide, please, babe. Compound interest is the 8th wonder of the world. That's the first thing the wealthy do very well. Their money is working for them while they're sleeping. The second thing that they do very well is protection. They protect themselves, they protect their income, and they protect their family. You are the most important person in your plan. If you fall down or if something happens to you, your whole plan crumbles. What sort of protection do you have in place for yourself? What sort of protection you have to protect your income, sort of income protection, yeah, if you lose your job? Two things are guaranteed in life, taxes and death. Why not protect the latter? Why not ensure the latter? So that when you die, because it's going to happen, unfortunately, your family's automatically better off. You've automatically created generational wealth. The third thing that the wealthy do very well is discipline. The philosophy of the rich and poor is this: the rich invest their money and spend what is left. The poor spend their money and invest what is left. What are you doing with your money? When you get paid, are you spending, and then whatever is left over, you're saving? Or are you investing, saving first, paying yourself first? I always say to my clients, pay yourself first before you pay everybody else. Pay yourself first. The fourth principle, which I think is so important now, especially considering the pressures that people are going to be on a day-by-day basis, is budgeting. Please let's not get this confused in any way, shape, or form. It's not the poor that budget well. It's the wealthy that budget really well, really, really well. I know wealthy people that budget down to the pound. Yeah. Here's a basic budget for you, basic budget plan. As I said, pay yourself first. Every time you get paid, 10% of everything you get goes to your pocket. I always say that whenever you save, you should be saving to 3 different pots: short, medium, and long term. Short is 0 to 5 years, medium is 5 to 10, long term is 15 plus. And we'll come to strategy as the fifth element. But what is your plan? What are you saving for? What are your objectives? And we'll come to that in a second. The second 20% is to pay off any debt you owe. Consolidate that and use that to pay off debt. Because if you once you become and then live on 70% of your lifestyle, 70% of your income, once you master living on 70% of your income, you will never be without money ever. If you can master that basic budget plan. Now there are many different plans and you need to decide what works for you, but if you can master this, a basic budget plan, once you finish paying off your debt, guess what you're going to be doing? You're going to be saving 30% of your income, because you now become accustomed to not using it, not needing it. So you now become accustomed to living on 70%, and you're now just saving that 30% every single month. You'll start to see your savings and your investments absolutely soar. And by the way, I didn't make this up. This came from The Richest Man in Babylon, which is one of my my investing Bibles, as I say. I always read this every year. I read it. It's such a powerful book. This is the book that got me started in sort of wealth management. The fifth, strategy and planning, purposeful saving. Have you ever sort of, if anybody that sits down with me, I always say, what's your objectives? What's your goals? What you're trying to do, what you're trying to achieve? Everybody always has a plan for their career. Why do you not have a plan for your life? What's your target in the short term? 0 to 5, medium term, 5 to 10, long term, 15 plus. Have you ever noticed that when you're saving for something, you save a lot more aggressively, or a lot harder, with purpose? The whole aim of giving you purposeful saving, or being purposeful with your saving, is to give you something to aim for, give you something to target. Most people that I know that are very well off, or that have that have done very well with money, is because they've set themselves goals and objectives. Not that they want to have £1 million in a bank account, but they want to be able to do this with money. They want to be able to stop working at a certain time, or have the ability to stop working at a certain time. Become accountable to somebody, work with somebody, work with an advisor, be part of a group that you become accountable to. Become accountable to somebody, that somebody's going to be able to pick you up and say, you said this was important to you. So strategy and planning. And then last but not least, allowances.
Jerran,
Wealth, yeah.
Not to, sorry to disturb you. What sniper shooting? What's that?
What's that, sorry?
Sniper shooting.
Oh, it's instead of just a scattergun approach. Instead of a scattergun approach, just a sniper shooting, purposeful saving. That's what it is. So that's the way I sort of just talk about it with my clients. Become a sniper. Don't just come the scattergun approach. Yeah. And then last but not least, allowances. Making sure you're utilizing all of the allowances that are available to you. And I call this the allowances pyramid. And effectively, everybody should be utilizing these vehicles, if possible, of course. Make sure you start with the basics first, foundation level, ISAs, pensions, and protection. This is the core foundation of wealth creation: ISAs, pensions, and protection. I would say in the order of protection, pensions, and ISAs. Yeah, I would say in that order. It's the foundation of any investment plan, of any sort of wealth creation. The secondary levels, once you sort of utilizing your pensions, utilizing your ISAs, then the secondary level is making sure you're utilizing your capital gains tax allowances through general investment accounts, or GIAs, making sure you're utilizing the onshore, offshore vehicles that are available to investors that allow you to save and invest in a tax-efficient environment, or tax-free environment, effectively. It's effectively a secondary pension offshore. And then you've got the sort of the private equity vehicles, which the government has put into place. And then last but not least, these ultra high net worth routes, which would be like share portfolios, or art, wine, property. I always find it strange when people are sort of doing all the juicy stuff at the top, but they haven't got their foundations in place. Because let's be clear, the foundations at the bottom are the most tax efficient vehicles first. So it's about making sure that you are, it's interesting. I know so many wealthy people, for example, that don't actually have property. What they do is they invest in REITs, real estate investment trusts. They don't actually invest in property, physical property. So again, it's just about having those different levels of investments and a diversified portfolio, which is allowing you to make sure that you can weather any sort of financial storm, or weather any sort of financial or weather any sort of financial scenario that comes across. These are the core ingredients that I believe, these 6 core ingredients to creating real wealth. Budgeting is super important in this time, in this day and age, especially with prices rising so fast. I'm sure people will ask about that, so I'll sort of pause on that there and sort of go to questions if there are any.
We do have a question, Jerran. So Samson asks, what is the best way to select income protection products? What should someone consider?
Income protection products, in my opinion, should only come when you go to retirement. I always find it strange how people want income protection. Sorry. Did you say income protection or income generating? Sorry, apologies.
Income protection.
Sorry, apologies. Okay, fine. So income protection products. So when we talk about income protection products, can you just elaborate a little bit more on that, Samson, if you can, if you're there?
I'm gonna step in and assume in terms of income. So sorry, Samson, go ahead.
Basically, someone was recommended to me, a financial advisor, and he said that I should get income protection insurance in case I fall ill or something and I can't work. So that's
okay, fine. So in regards to protection, okay, fine, and insurance, fine. So income protection, typically you'll get. I always say when it comes to protection, look at what you're getting first from your company. Okay, so you get some stuff from your company, you'll be employed, and you'll get the standard benefits, which will be potentially life insurance, critical illness, and income protection. Always start there first. Always start and look at those products first, because they're typically, if you go into a big organization, you get discounts because you're part of that bigger organization. And then once you've sort of made sure you've benefited from the company protections and the company insurances, then it's always wise to look outside and say, what if I left this company? The question I always say to people is, if you left the company and you went to another company that didn't give you as much, how much more expensive would that protection be? So, for example, life insurance, as an example, the older you become, the more it costs. So we always say that it's important to, if possible, providing your finances allow you, to have protection outside of your company, just in case, because gone are the days of people who spend lifetimes in a company, in one company. So you want to make sure that when you do go to another place, your protection, so to speak, you're not under protected because you've now gone to another place and the benefits are not as good. Does that answer your question?
I would say so. You mentioned three things: life insurance, critical illness. What was the third one?
So life insurance, critical illness, and income protection.
Income protection.
Yeah. So again, income protection is just simply you can get a protection up to a certain amount of your income. So if you were to fall ill, you were to stop working, then that income protection will kick in and allow you to receive an income, typically up to around 60-70% of your income.
60 to what, sorry, percent?
60 to 70% of your income.
Oh, okay.
Yeah.
Yeah, okay, that makes sense. So basically, look at the company's offerings first and see what.
Always look at the company's offerings first, because as a company, you're coming as a bulk, so they get bulk discounts.
Okay. Oh, sorry, I had one more question, because someone put a question in the chat that made me think about this. So basically, when your company says they can match your pension contributions up to a certain amount, when you do that, can you explain what happens exactly? Because I still don't understand it when they say, well, people advise that you should match it so you get more in retirement, but I don't really understand how it all works.
So matching is probably one of the best things that's happened to pensions. Okay. So matching is simply, let's say you went in to a company and they said they're going to give you 5% to your pension as standard. Okay. But they have a matching sort of program, which means that for every percent you put in, they will match that 1% up to 5%. So they give you the standard 5% as standard as everybody. But if you put another percent into your pension, or another percent up to 5%, they will match your up to 5%. So you can end up with 15% into your pension every month, but you've only paid 5%. So they've given you 10%.
Repeat that. How did you get from 5 to 15%?
So you get the 5%. So again, just going back to the example is that you get 5% as standard as part of your benefits. Yeah, let's just use that as an example.
Yeah.
But the matching element would be that for every 1% you put in, that they will match that 1%. So if you put in 1%, they'll give you another 1%. If you put in, up and typically companies will have a threshold. So they will say, we'll give you matching up to 5%, meaning that, or up to 10% or whatever. So they'll say that if you put in another 5% into your pension, they will match that 5%. So you got your standard 5%, you put your 5% in, and then they will give you another 5% on top. So for your 5%, you've received 10%.
Okay, I think that makes sense.
Yeah.
Jerran, do you mind if I ask a question ask the question that was also put in the chat, just around pensions, just a little bit more of explanation around that? Because I, for one, I'm going to be honest here, when I started work, goodness knows how long ago, 7 years ago, and they were told me, you can elect to give a certain amount of your income towards a pension. I was like, I'm not giving away any of my income, I'm keeping that. But now, knowing what I know now, I'm like shooting myself. I shot myself in the foot, I feel, because I didn't benefit from all that kind of matching of income that you're talking about. So if you could just like literally back to basics, explain what that workplace pension is, and what exactly is it that they're doing with our money, and how can an employee make sure that the money that they are, like, how do you keep tabs on the money that you're contributing to your workplace pension?
So yeah, okay, so let's go back to basics with pensions. So pensions for me is probably one of the most tax efficient vehicles in the UK stroke, definitely in Europe from the places I've worked in. And what it is, it's effectively for any money that you put into a pension wrapper is tax-free growth, tax-free income. You only get taxed when you start to draw down on it, or when you start to receive an income from it, and that's from the age of 57 onwards. Okay, so typically, let's just again dispel some myths. Retirement age or state retirement age is different from your pension retirement age. You can access your pension from 57 onwards. Yeah, not 67, 68 or whatever. Okay, so that's the first thing to note. The reason why pensions are so tax efficient is because, as I said, you don't pay any tax on it. So an example, everybody is a basic rate taxpayer. Everybody, okay? So for every pound you put into a pension, you get 25p free from the government on your pensions, okay? Now, there's two ways to add to your pension. There's sort of the private way and there's the company way. The company way is that you put money, your pay gets generated. Please follow me with this one. This can get a little bit complicated. Your pay gets generated. You then your money then gets contributed to your pension. Your money is then taxed, or whatever is left over is then taxed, and then you are paid net of tax. So as you can see, following that train of thought, your money is added to the pension gross of tax, or before you're taxed. Okay. So that way, as you can tell, your money is being contributed to the pension without you paying a single shred of tax. The private way is that you put, for every pound you put in, you will get 25p, literally. So for every pound you put in, the government will top it up for you. I.e., what they're doing is just giving you the tax that you paid, just giving that back to you. Okay. Now, if you're a higher rate taxpayer, for every pound you put in, you'll get 40p. If you're an additional rate taxpayer, for every pound you put in, you get 45p, i.e., you get the tax that you've paid back into your pension. That's why I'm saying that actually, in a way, pensions are one of the most tax efficient vehicles, full stop, because it's basically giving you, as a basic rate taxpayer, 25% without any risk at all. Now, from a company perspective, as I've said, for every they add the money into your pension before you pay tax, so that money's already gone in net of tax.
Whoa. Sorry, Jerran, I've got a question. You know the 25 pence that you get for free for every pound you put in. Is that the lice or is that the SIP?
That's it's on a pension, so it'll be a SIP. It'll be if it's a company, it'll be a company pension, or if it's a private pension, it'll be a SIP.
So what's the difference in should someone stick to the company pension, or should they open a SIP instead?
That's a good question. Sorry?
I do both.
That's a good question, yes. So I always say, first and foremost, make sure you are maximizing the pension allowances at your company first. And you're maximizing the matching available at your company first. Once you've done all of that, then the question remains, or the question is, what is your company doing with your money? Where is it invested? How is it working? And if the question is, it's not that good, then open up a private pension, because typically on a private pension, you will get a lot more investment options and a lot more options available to you.
Just to expand on that a little bit, Jerran, because some of the questions in the chat are around what the company's doing with your money. I've been at companies where they are a little, very standard. Everyone's kind of on the same rate and the same kind of risk profile, as it were, and then you as an employee have to go into your account and change your risk profile if you want it to be a bit more aggressive and investing in a bit more sort of potentially high risk but higher return assets, or vice versa. And I've also been at I know of companies where they're a little bit more intuitive and they kind of look at your kind of age bracket and make an assumption. But ultimately, I think my advice to everyone would be to make sure you know where your pension money is going. Because I think for my first kind of 3 to 5 years of employment, I'm just paying in. I knew it was Standard Life was the pension provider, but I'd never actually logged into the Standard Life login to just even see where they're what they're buying with my money, or how it's doing. It was only when I left the company and then had to basically look at potentially transferring my pension pot that had built up under Standard Life and maybe look to transfer it to my new employer's partner in terms of pension. That's when I was like, oh wow, I had no idea I'd been built like this pot had just been sitting there. And on first look I thought, oh wow, this is I've got X amount of money in my pension. But then when I actually looked at it, it hadn't really moved because it wasn't being managed effectively. So I think your point there about researching who your company, where your pension is going and what that particular pension provider is doing with your money. And if it isn't working for you, obviously speak to an advisor and then maybe look to open that private pension where you can be a bit more flexible with what you're doing. And Dwayne here said to sort of everyone in terms of making sure that your age can sometimes impact how much you're willing to invest. So in terms of age, would you kind of say typically if you're sort of younger, you should be a little bit more, I don't know, aggressive or opportunistic with the investments that you're looking at from a pension perspective?
Yeah, I would just add. I'm going to add to that, and then I'll come on. I'll touch on that question. So the thing is, I would say about company pensions are this: their job is to get you there safely. Their job is not to shoot the lights out for you. Yeah, their job is to just get you there as safe as possible, without as least hiccups as possible. So that's why I've said extras, or once you've utilized all of the sort of the standard benefits of using a company pension, you look elsewhere, because there's a good chance that looking elsewhere you'll be able to bolster that pension with better returns and better funds and more options. Okay, to answer your question, Dwayne stroke Faith, I would say that the question you've got to be asking yourself is, what's the target? A lot of people are I would say blindly paying towards a vehicle, paying towards pensions, and they have no idea what they want or need as an outcome. Yeah, so things that I focus on, and this goes back to the objective and sniper shooting effectively, is working backwards. It's not just saving on a monthly basis just because you're told to and you should do, but working out, what do you want, what is the target, and how much do you need to be saving on a monthly basis to achieve your goals and objectives. That's the way you should be. So you should be working backwards. Yeah. An example is, for myself at 55, I want to be able to have 5K worth of income, net of tax. Okay. So 60K a year. Typically speaking, 1 in 4 is living to 100. So I've got a plan from 55 to 145 years of low to no income. At 60K a year, quick math, you're looking around about 2.7 million that I would need for that 45-year period. Now, Do I need 2.7 million at 55? No, I probably need around about 1.5 to 1.8 million. Brilliant. Now I've got my target. Now, what have I got to be doing on a monthly basis to help achieve that? And that's and save on a monthly basis, on a yearly basis to achieve that. And that's the sort of calculations you need to be making and you need to be doing on a monthly and yearly basis. Remember, the reason why I always say become accountable to somebody, because this is not just a 1-year plan. Typically speaking, when you put plans in place, it's a 20-year plan, a 20-year goal, 25-year goal, 20-year plan, that you've got to be constantly tweaking, tuning, fine-tuning every single year. And that's why I said become accountable to somebody, because you will make excuses for yourself as to why you haven't saved enough that year or whatever.
I just want to drive home that point that you made before I move on to another question that's been posted in the chat. I think that for me, what kind of got my jaw dropping was the fact that, you know, you're putting into a pension, you might not think it's like worthwhile, but then when you think about how early you want to retire, and like for me, for example, I want to be in a position to retire early, 55. But then when you think about how long you're going to have to live, and if by 55, presumably everyone on this call would have been doing well for themselves in terms of their career, they might be on 6 figures plus, who knows? So to go from that to then drop down to drawing income from your pension, and if you haven't been effectively putting into your pension, you could, you know, get a bit of a shock of your life when the standard of living that you've kind of gotten used to then has to drop when you retire. So I think that's so important. And I think often, particularly young people coming into their kind of first, you know, workplace environment, they might think, oh no, I want to use my money now. I don't want to give my money into the future. But really, you have to be thinking about your future self and the kind of lifestyle you want to live. You know, if you want to be going on all those holidays, buying all those designer stuff, or whatever it might be, at that point in time, you're going to have to, and also think about at, you know, 55, you might have kids, you might have a mortgage still to pay, all this kind of stuff. So yeah, it's honestly so important. I can't express how much, and you know, that was something that I didn't even really consider until 2 years ago.
Yeah, agreed. I categorically remember, it's not the whole aim of this game is not hard. This game is really not hard. It's about doing a little bit over a long time, allowing the compound interest to work in your favor. But again, it's making sure that the investment is done in the right way, because one bad year could take you years to recover.
Yeah.
I have a quick question, sorry, Faye.
Hmm.
So at one of my old companies, they said that we could either do salary sacrifice or auto enrollment with the pension, and I just wanted to understand the differences between the two.
So salary sacrifice is what I've just explained, where you're sacrificing your salary or sacrificing a portion of your salary to go into a pension. And again, you've got the standard, you know, you've got the standard, so let's say 5% as an example, as I used before, and then you can do typically you can do some AVCs or additional voluntary contributions, additional voluntary salary sacrifice contributions to effectively get that matching facility. Now, auto enrollment is in a way the same thing in a way, because auto enrollment was a vehicle that was put into play by the government, and the whole point was that they realized that there's millions of people who were not adequately prepared for their pension. So they put into play this auto enrollment, where when you are earning a certain amount or where you're at a certain age, the company you're working with has to contribute to a pension unless you opt out for it. And that's that 3 and 5% that you might be hearing about, where the company will pay in 3% and you'll pay in 5% of your income. So those are in essence, they're the same thing. Some companies will offer the auto enrollment. Some companies will offer the salary sacrifice.
And is one more tax efficient than the other, or does it kind of depend?
It doesn't. Because it's all going into a pension. There is no more tax efficient than the other.
Okay, thanks.
No problem.
Chloe, did you want to ask the next question?
Oh yeah, just on your pyramid there, it said that it spoke about the GIA and private equity and offshore bonds, and I just wanted to understand the sort of alternative investment ideas, because I've heard of a general investment account, but I'm not sure of any sort of alternative ideas to that.
So you other, once you've utilized, let's say the GIA, the onshore offshore bonds, and the private equity stuff, alternative investments could be crypto, alternative investments could be property, alternative investments could be art, wine, whiskey. You know, those are what we deem as alternative investments.
Great, thanks.
No problem at all. But I would just caution that if you're not utilizing the sort of pensions and ISAs, then yeah, I would stay away from the alternative investment, because the level ones are the more, in my opinion, the more tax efficient vehicles.
Yeah.
Yeah.
Thanks, Chloe. You've got your hands up.
Yes, hopefully you can hear me properly.
Indeed.
Thank you, really informative. Just thank you. Totally agree with you on tier one and making sure that's all covered. Just in spite of everything that you were saying around the difficult markets, 10 years previous, not looking like the 10 years moving forward, what alternative and where do you see investment opportunities? So how do you feel, you know, some of the investment opportunities that we've been seeing in the past moving and changing, and where it's hard, I know, difficult question, but yeah, where do you see the trend, or what are you advising your clients to start moving into?
Yeah, first and foremost, no, good question, tough question, but good question. First and foremost, it's all about diversification. I know that's sort of like a very broad buzzword, but that's super important. And the reason why it's so super important is because the landscape is going to change. What that's going to look like, one doesn't know. That's the problem. So you want to keep it, or try and be as broad as possible with your investment strategies. I always start by saying, what are your goals? What are your objectives? You know, the three different pots: short-term, medium-term, and long-term pots. So pensions are always going to be the most tax-efficient vehicle, in my opinion. So for the long term, we always look at pensions. Pensions, ISAs always form part of your, and protection always form part of the planning. But even today, I started looking at a client with a few hundred K, and they've already been doing their pensions. They're doing the pensions regular. They've maxed out their pension. Sorry, they're doing their ISAs on a regular savings every single month. So what we started to look at was sort of some more exotic investments, such as art. We started to look at some whiskey and wine. We started looking at some structured notes, some structured products as well. We started to incorporate or start to look at REITs for their portfolios as well. We're looking at, there's a vehicle called Prudential bonds, for the Prudential, and it's sort of like a proof smoothing fund. So what I'm doing is sort of giving their portfolio mix and match of some high risk stuff and some sort of alternative investment stuff, but also some vehicles that are, I don't want to say guaranteed because there's nothing guaranteed, but some sort of very low risk, very low yielding portfolios. And I'm trying to move them. I'm trying to get them not to be so 100% invested into the markets, and to have that you know, diversification across multiple different asset classes, just to make sure that if the market does turn, if the government did decide to increase taxes on pensions, or, you know, like they did a couple of years ago, increase taxes on property, or like they've done this year, increase taxes on companies through increasing dividends. We're so diversified. We've got about 4, 5, 6 different avenues that we can draw income down from, then it doesn't matter.
Okay, so there's no specific market per se, looking at the, you know, sorry, asset class, looking at the market that you're saying, well, you know, maybe, and the reason I say this is, you know, I've heard 1 or 2 opinions from, you know, other wealth managers, etc., just around the move from, you know, asset wealth to kind of labor wealth, and a worry around, you know, the assets currently, you know, stocks and shares currently being quite high, and the impact that the labor inflation could have, and therefore maybe diversifying away from certain areas. But it's just understanding your view in light of everything. Like, there's no crystal ball.
Yeah, I think a lot of that thinking is one, speculation. I think 2, because there is no crystal ball. So, but 2, also, it's such a hard thing to try and predict where the next trends are. And the reality is that if you get it wrong, as I said before, you could spend years trying to recover from that. So it's important to have a diversification, and maybe have a little bit in different pies, to try and keep yourself, you know, sort of spread and abreast across different asset classes and strategies. But I wouldn't say that any one strategy is sort of prevailing right now. You know, you could even sort of look at crypto and say that hasn't necessarily prevailed in a way that we would expect it to see, because for all intents and purposes, I think this year alone, or definitely in the last year, it's had 3 50% plus drops. You know, that's sort of like, not that's more than market correction territory. You know, that's sort of like, that's market crash. Like, you know, if we had a 50% drop in the stock market, that would be quite horrendous, right? So, you know, I think that it's important to I stay away from the gambling element of investing for my clients. I definitely stay away from that. And I think sometimes when you're trying to speculate, there is an element of, I don't want to say gambling, but an element of lucky dips in some cases.
Thank you. So diversification is key.
Diversification is imperative. Cheers. Is imperative.
Could I jump on that? Sorry, Jerran, it's Arnold here. It's interesting. Yeah, I'm good, mate. Interesting point from Ira. Sorry, I'm going to just jump in and just go straight for the jugular. So I feel like you're being a bit coy when you're sort of saying, well, we're not really quite sure where the market's going to go, because if you're the wealth manager, and, you know, obviously you're saying that you sort of deal with clients up and down the sort of the financial spectrum. There are some people here who might be thinking, well, look, I've got to take my, you know, whatever's in my bank account, I want to give it to Jerran to do something with me. So I don't really want to, you know, hear the textbook answer about depends what the market's going. You're supposed to be telling me where the market's going. And I feel like with enough of these, I don't know, new innovative products. I mean, I barely understand crypto. I totally missed the train on that one. NFTs are coming up, and you know, I was watching someone the other day on BBC News talk about how they do all this stuff with the NFTs and they bury all this art in there. And I'm thinking, well, you know, can we start using some of these digital products to now start investing in property, so that I don't have to put my, you know, 100K down, 150K down, then I don't have to take the downside risk. You know, you're talking about people who invest in REITs, for example, who don't have to take the downside risk on, you know, property taxes and that kind of thing. So, I mean, you know, you tell me, you know, you're supposed to be defining the market. You tell me what should we be doing? you know, and, you know, get out of this diversification. I don't want to hear that word. I hear that all the time. You know, what's your view? I mean, I've spoken to you in so many different quiet corners, and you know, I feel like you're giving me the responsible answers here. I want the irresponsible answers. You know, I was just been talking. He's got 2 kids. I've got 3. I'm trying to think. I'm thinking about how to offset my inheritance tax. I'm not thinking about my pension. I'm not going to see that for another. I'm not going to see that full stop. Like, do you know what I mean? I need money now.
Yeah, fine. I mean, look, you know, one has to be very cautious about giving. Everybody's risk profile is different, right? So your risk profile is different from somebody else's. So if you want a more in-depth chat about your particular situation and what your particular risk profile looks like, then we can have that conversation.
Well, not so much that I'm not interested in so much the particulars of my individual situation per se. I mean, you're talking about sort of a senior professional in the industry, you know, good earner. Yeah, reality is I'm 37, so I'm not going to be seeing my pension for another 30 plus years. So you know, generally speaking, pound for pound, what should somebody in a similar position like myself, family man, what should you be doing? If A, you need cash now, but B, there are all kinds of innovations that are coming up into the industry that can be used, you know, in a wealth of ways. I mean, okay, fine. Look, property investing in the underlying asset is one thing. We could be talking about investing in different kinds of products, such as, you know, ground rents, you know, different kinds of leases, whatever it happens to be. So there are all those kind of I don't want to say old, but there are all those sort of investment metrics that we can do. But if we're sort of looking to sort of put more in real estate without, you know, being exposed to the downside risk, which is always going to be taxation, because that's the thing that they just keep tinkering with, that goes up and down. You know, what are the kinds of things that you're sort of sitting there in your diary room or whatever you want to call it, your study, and you're sort of thinking, that's quite interesting. I you know, this could be one for Mr., you know, double-barreled surname or whatever his name is, that's, you know, decided to give you to, you know, that's I'm just picking your brain now.
Yeah, no, it's fine. So as I alluded to with Aya, one of the things that I, and maybe I didn't talk about it a lot more because there's a lot of risk involved with it, and for all intents and purposes, the understanding has to be there when you invest in it, is structured products, because structured products gives you very much a downside risk. So, for example, if the markets, let's give an example, Barclays will underwrite a vehicle for you. They'll give you 10, 15, 15% a year. And if the markets sort of crash, they give you sort of like a 30, 40% protection on that. But, you know, for all intents and purposes, that is very much a specific product, a tailored product to somebody who understands the risks that's involved with that. So, for example, as an investment professional, I can't just give that to anybody and everybody, especially if they don't have the basics in place, because now you're trying to gamble. You're trying to make a quick buck. You're trying to gamble, and that's what we don't do. I don't do that for my clients. So, you know, we could talk about crypto. We could talk about a fund that we're trying to raise or trying to create for some of our clients. But again, these vehicles are for people that are, in my opinion, have done the basics and are understand the risks involved with those sort of vehicles, because they are high risk and they give a lot of high return, but they do come with a lot of risk. So, you know, as I said, those kind of conversations are definitely to have offline if you want to have those conversations, because it's,
you're still being coy.
100% being coy, because what we're trying to avoid is the sort of, oh, you know, invest this and you're going to get 15-20% returns.
No, I'm not asking you to sign a contract in blood or anything like that. But look, we all know about pensions. Those of us who, you know, who have the concentration and the patience pay attention to them, and those of us that won't. You know, I've been putting money into my pension for however long. It took me, I can't tell you how long it took me to consolidate all of my pensions. It was one of the most complicated things I've ever done. But having done that, I never want to talk to those guys again. That's me done, balanced, whatever. Yeah. But I think it's now just sort of like, right, so that's level one, tick. Level two. Now, what's the next stage? What are the innovations that are coming into the market? Like, you know, you talk about, you know, at the beginning of the conversation, beginning of the presentation, you said that you want to get into more of a conversational piece. So this for me is the conversational piece. Where do you think that, you know, what do you want to do? I'm just curious.
Hang on. I'm going to jump in here real quick. I literally left the chat for a second and I come back and Arnold is grilling Jerran. Okay. I'm conscious that we've gone about 10 minutes over time. So for those, I just want to say, for those on the chat who need to go or need to leave, if you want to get in touch with Jerran directly, his email is in the chat at the moment. So take those down. Jerran is open and willing to have these kind of difficult conversations with you directly, because as we know, you know, what you're able to invest or how you're going to invest and is very specific to your circumstances. I appreciate, Arnold, you're really trying to get an answer out of Jerran, but I don't think you're going to get it unless you contact him directly and have, you know, a really in-depth discussion as to what could work for you in your particular circumstance. Arnold, did you have anything else to say?
Just, you know, you saved him. No. You know what? Like I said, it wasn't about an individual question about my particular situation, because obviously that is an offline discussion. It's more about, look, we've spoken about the pensions, we've spoken about that side of things. We talked about the diversification, which is very much an entry level one sort of thing. So once you kind of clock that sort of stuff, what is the next? You know, what do you think the next things that we should be looking at? I mean, you talked about ISAs, you know, because as you get older, you do get into things like families, and, you know, someone was talking about income protection, and then we talked about income generation. You know, I think you talked about, you know, cash flow, and I heard you say something about £5,000 after tax. So it's just generally like, okay, what are the interesting routes of investigation that one could probably do some additional reading, rather than sitting down for sort of a focused discussion, which in fairness, this is probably going to lead to that. It was more like, okay, what are the next areas? What are the next things we should be kind of like paying attention to that sound interesting to you, that you might be, you know, just having a little bit of a humdinger, but being respectful of what Faith has said, we'll have to save that one for another time.
I would say it goes back to, I would say just lastly to finish off on that, it definitely goes back to the allowances pyramid, right? So to your point, once you've done the basics, which is what you're talking about, we then go into the secondary level, which is the GIAs, which is utilising your capital gains tax allowances. We go into the onshore, the offshore bonds, which is investing outside of the UK in tax efficient locations. Though that there you get a lot more freedom as to where and how you want to invest your money. Then we go into the VCTs, EISs, the tax, the sort of private equity, investing in startup companies, investing in companies that are, and because of what we do, we get access to companies that are pre-IPO, for example, and those sort of things. But again, it goes down to are you doing the basics? Because if you're not doing the basics, then my clients, they get a sniff of that stuff if they're not doing the basics, you know, and that's why I'm staying very headstrong with it come down to the personal situation, because everybody wants to make £1 million tomorrow, and I'm so conscious of that I vet these sort of vehicles and make sure that if these clients are not doing the basics, they don't get all that sort of juicy stuff at the top, you could say.
I appreciate that. And final one, and I swear it's an easy one. Difference between a wealth manager and an investment manager, please. Interesting,
because Faith had that on as a question as well. So that's a good question. So I was taking a step further and say financial advisor, wealth manager, and investment manager. So a financial advisor is somebody that's it's very much a loose term nowadays. It used to be somebody that just invests, that gives you financial advice and then sort of enacts the plans for you. Okay, but now a financial advisor is a very loose term that anybody and everybody uses. So I've seen insurance brokers use it. I've seen mortgage brokers use it. So financial advisors have now started to coin the term wealth manager, wealth managers are people that manage wealth. Typically, historically, wealth managers were people that manage wealth for wealthy people. And it was sort of wealthy people were wealth managers. And typically financial advisors for the everyday person. And then investment managers are typically people that are managers that are sort of managing the investment or the investments for sometimes wealthy people, wealthy family offices, or they work with the wealth managers and manage the investments for the wealth manager and their clients. So we, for example, have an in-house investment management team or an external investment management team, which help us do our investments and our management of our investments for our clients.
Brilliant, thank you.
Thank you very much, Jerran, and thank you, Arnold, and everyone that contributed to the questions. This session has been recorded, and so it will be made available for viewing afterwards on our YouTube channel. Please do reach out to Jerran. That's jerran.whyte@belvederewm.com if you want to just continue the conversation further. Jerran has been very gracious in giving everyone that's on this call the opportunity to get a free sort of follow-up consultation call with him if you book that in before the end of June. So you've got 1 month in which to book time in with him, so you can have those really targeted conversations with him as to your situation, your circumstances, and how you can make your money work for you. Thank you, Jerran, very much for your time this evening. I've been Faith Locken. I hate saying that, Faith, but we've been We Rise In. We host events such as these online and also in person as well. So we hope to see some of you guys soon, if that's not in person or online. So thank you very much. We will end the recording there. Well, I'll end the meeting. Bye, guys.